Hi everyone and welcome to the Profit Playbook. Today we're covering exit planning and strategies around that. Did you know that 48% of business owners admit to not having an exit plan? Today on the show is Ed Gooderham from Green & Co Accountants, joining me to navigate this issue, who has extensive experience in helping clients with exit strategies. So thanks for joining us, Ed. So I think to give the listeners a bit of a better understanding of the episode, can you tell us exactly what exit planning really is?
So exit planning is just a fancy name for how clients come out of their business, how they exited. As it says, exit being either sale of the business, it could be retirement of the business, it could be passing it down to the next generation. And the whole strategy part is, well, how are you going to achieve it? So I might have a client who wants to sell their business, but I might want to work with them for 3 years before they sell to make sure that it gets the maximum value they could possibly achieve for it.
That's interesting. So when should business owners really start thinking about exit planning then?
It's a very good question. We're quite different in the way that we operate as accountants, in that we help clients achieve their goals, and we talk about goals right from the first meeting we have with clients. And one of those goals I always say to clients is you should always have an exit strategy, because you don't know what's going to happen. And you also, though, if you're running your business so that you're in control of it and it's not in control of you, then an exit, it should always be on the cards if you want to, but not making you do it. So any time when you're running a business, you should always have an exit strategy.
So what type of exit plans and strategies are there?
Oh, there's loads. So the client might have family who want to take over the business, which is quite nice. They look to pass it down to them and how we can do that tax efficiently. They might have management team, so they haven't got any family they can pass it down to, but they might have good managers in place who they want to look how they can pass it down to them, but obviously get value out of it. So they sell it to them and take money out of the business very tax efficiently. They might have nobody and the business is very small and they might just want to stop trading. I had that recently with a client. And then you're just liquidating the business themselves and taking the cash out depending on how much value there is. If there's a very big liquidation, then you might actually have to get an insolvency person involved. The other ways, sale is one everyone talks about.
Yeah.
Doesn't happen that often.
Yeah.
In my experience, and it can be a very long drawn out process. So yeah, there's lots and lots of different ways it can happen.
Like your clients talk a lot about trying to maximize business value and improve the value of their business. Are there things that you tend to focus on with clients to try and improve the value of their business?
Yeah, so if they're trying to look for a sale of their business, then you want 2 really good years before the year you're selling your business. Unfortunately, most valuations are based on EBITDA, profit of the business. EBITDA is earnings before interest, tax, depreciation, amortization. It's a very accounting term, but most people who are looking to sell their business hear about EBITDA, and they have a multiple of EBITDA of the value of their business, plus any cash in the business. And that's very important for the client to look at in terms of how they can make their business more profitable those last few years. Are there things that they've been historically putting through the business themselves that they might want to take out just to make it even look better? Obviously, if you're paying yourself a pension or got a company car or any of those sort of things, you can exclude those from the deal and adjust the EBITDA for them. So there's lots of technical issues that you need a good accountant to help you with.
Yeah, absolutely. And what about things like the operations of the business, revenue streams, staff? Do you consider all these different options?
Yeah, the most common issue I find with clients is they normally get to a point in their business where they're struggling. They're working really, really hard. They're not taking as much time off as they'd like to, and they basically had enough and they're burnt out.
Yeah.
And they're the ones who normally come to you and say, I just want to sell my business.
Yeah.
You're like, right, okay, what are you really trying to achieve? And they said, well, I just had enough. Now, in order to sell a business, you have to make the owner almost exempt from the business,
Yeah.
so the business can run without them.
Yeah, you talk a lot about this detaching yourself from the business. It's a bit of an alien concept, isn't it, for most sort of business owners?
That's right. Most business owners, they are their business, and they live and eat and breathe it. So the whole aim for us as advisors is to try to help them step back from that, and then put a management team in place as long as the business is big enough and profitable enough to take it. And it takes a lot of the pressure off the owner. The big issue then normally happens once you put a decent management team in place and suddenly the owner's not so stressed out and hasn't got so much work to do, all of a sudden they actually enjoy their job again. They don't want to sell it anymore.
And they don't want to look at the exit of externally, third-party sale, which is why it probably doesn't happen that often.
That's right.
Succession tends to take more of a front foot then, essentially speaking.
That's where they might just change their mind, run the business for another 5, 10, 15 years, but then the management team might buy it out.
Which is where that term really comes from, doesn't it? Management buyout, which is another form of exit as well. A lot of interesting stuff there, Ed. Different types of strategies you can look at. Have you got any client examples or case studies, really, that you've called upon in practice?
Yeah, so I had a client several years ago who wanted to retire. He actually wasn't my client. He's one of the other partners. And they had a good management team. And the management team were going to buy out the owner, which was quite a nice way of doing it. They worked together for a long time, so they knew each other, they knew the business inside out. So that works really nicely. And it was nice, straightforward, had meetings, discussions, trying to work out the most tax efficient way for them to buy it, the business and the shares.
Okay.
Obviously for the seller, they want to sell the shares because they only pay 10% tax on the first million and then 20% after that.
Which is business asset disposal relief.
Business asset disposal relief. The big issue for the buyer is they're trying to buy those shares the cheapest way possible. Now the client originally was going to buy them in their personal name, where they just buy the shares off the seller. The problem with that is they'd have to pay tax on all the income to repay the seller, which suddenly increases the cost of it greatly. When you're paying 40% tax on your income, you're using that, so you've got 60% of it left to pay the person.
Yeah.
The deal was over 8 years, and it was a fairly large figure of £800,000, so you're not talking small amounts. So the best way to package one of these deals is you create a holding company for the new buyers. They then buy the shares off the seller with either we use redeemable preference shares, but you can use loan notes to make deferred payments, and then you vote dividends from the main trading company up to the holding company each year. No more tax other than what you're paying on the profits of the company, and that just gets paid out to the owner each year. And that's the most tax efficient way of doing it.
You make it sound easy, but I know this is a very complicated area in practice.
It was very complicated,
Yeah.
and there's many issues with that client where property had to be stripped out of one company and put into another company.
Yeah.
We had to create groups in order to do it most tax efficiently.
Yeah.
They're not straightforward, and sadly the fees can get expensive both for solicitors and accountants.
Yeah.
But if you do it properly and keep a control of what's happening, it can still work for everybody very, very well and be very tax efficient.
So probably some of the key takeaways from that, that's an MBO, a management buyout structure. Having a really good a sound management team in place in order to basically allow that strategy to happen is potentially key.
Which is also the best way of running your business anyway.
Yeah.
It gives the owner the least amount of pressure and stress.
So it's probably more of an internal strategy, trying to, in terms of succession planning, for instance. What about external third-party sale? Got any examples around that?
Yeah, so I had an external sale of a large client turning over 15 million. So nice sized business, making good profits each year. External sales are much harder. Firstly, you have to normally go through an agent who normally goes across the whole country to the similar sort of businesses or slightly larger businesses to see if anyone's interested in buying somebody in that area without giving away their name. And then once that you find a buyer or a few buyers, you then have to sign NDAs, non-disclosure agreements, pass over accounts and other information so that they can do some due diligence, and then they can start having conversations about if they want to buy the business, if you want to work together, because obviously you're leaving your management team behind, all your staff. Is that new buyer going to be the best person for them as well? And lots of clients really care about their staff.
Yeah.
And then following that, once you get to a position where you might actually get a deal, and then is the deal actually what the seller wants?
Yeah.
And that's normally where these things get tripped up, because the buyer wants to pay as little as possible, the seller wants as high as possible as a price.
Naturally, yeah.
And these sales agents are very good at selling the idea of getting a big EBITDA, as we talked about earlier.
Yeah.
But when it actually comes to it, they always get discounted somehow for various things when the seller gets involved. And the selling agents are very good at trying to massage the information to show the seller that it's a really good deal, this is now.
Yeah.
But yes, I mean, they can be time consuming. Again, you've got big solicitor fees, accountancy fees, got all due diligence and interaction. But it is a good way of selling big businesses.
Yeah.
Because often you'll have situations where you've got good management, but there's an awful lot of money involved. And once you get to a few £1 million, then most people don't want to wait for that money, because they want to retire and go and enjoy themselves and actually spend the money. So sometimes those third-party sales are the only way to do it.
Yeah, you hear this a lot, and the outgoing owner looking to be retained in the business as well, post-sale, almost like an earn-out, which can put a lot of business owners off as well. Have you come across that at all?
This is where we try to educate the clients whilst they're working with us to step away from their business and put a management team in place so they can run their business rather than be run by it. And then when it comes to a sale, they're not a key part to the business anymore. If they're the main salesperson, they're going to really be stuck trying to sell the business, because it is them.
That's it.
Whereas if you can put other salespeople in different regions and then step yourself back, you can sell the business without you being linked to it for too long a period. So most third-party sales, you're talking 3 to 6 months. The main shareholder might be involved. Then after that might be a consultancy fee, but they will hardly be involved in the business.
So, Ed, there's a lot of good stuff in there, but obviously a lot to unpack. If we had to break this down for the listeners, what are some of the key steps we would want to take away?
So the first thing is to plan and to think about when you want to exit your business. The second thing is to look at your financial value in terms of your business, look at your profit and loss, your balance sheet. There's plenty of things online to show you how to calculate EBITDA. And the rule of thumb normally is EBITDA times 5, less any borrowings in your company, as a good rule of thumb to value your company.
That's good stuff.
If you've only got one main customer, that's going to really cause an issue when you come to sell the business. So you really want to look at getting more customers, spreading your customer base so that it's got more value to people. People do sell businesses with just single customers, one large customer, but then the value you're going to get is much lower because it's all hinging on that customer staying with you.
Cool.
And lastly, your management team. So you might be a small business growing and you're thinking, well, what could be my exit in the future? It could be that you are a decent sized business with 10, 15, 20, 50 employees and you're just struggling with the pressure of it. Like I said earlier, is it a case of getting the right management into the business to help you to take those pressures away? But also it helps it to be far more saleable in the future.
Thanks, Ed. That's a really good rundown. And thanks everyone for watching the Profit Playbook. Don't forget to download our ebook in the comments section below. And don't forget to like, share and subscribe. And if there's anything you want us to cover in a future episode, please leave a message in the comments below.